I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino. He's the author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Good to be back, Jim. And, it's good to be able to breathe now after a summer of forest fires, huh? I'm glad to hear yours have cleared up a little bit, too.
Yes, now Vancouver's skies are gray for the right reason, rain. And by the way, Vancouver had its driest summer ever. We are not a permanent rainforest, just, I would say through the fall, winter, and spring. But once the rain decides to end sometime in May or June, it's over. And we were just lucky we stored up a lot of water from a very wet winter last year. Anyway, so yes, very nice air to breathe here in Vancouver, and the scenery is turning green again after being brown all summer.
Nice.
Speaking of green, of another kind, President Trump was on television today saying, yes, my tax cuts are going to come in, and once they do, the economy in the U.S. will be better than it's ever been. Will he ever actually enact tax cuts that help the average person, not just his billionaire buddies?
Well, the thing to understand about tax reform in the U.S. is that we do it all the time. And it's really just a big scam that allows the congressmen and the senators on the tax rating committees to extort money for their next reelection campaign from anybody who has any kind of a tax break out there. Because what they do every single time is they say, well, we're going to lower rates and we're going to close down a bunch of tax loopholes to pay for the lower rates. Well, everybody that's got those tax loopholes then has to go identify the congressman that can hurt them and then give them a bunch of money. So it's basically an extortion racket. And we do it every time. And it very seldom amounts to much of anything. So it would be a big surprise if this one did, because it's hard to do. Closing tax brackets or tax loopholes enrages small groups of people. And if you close lots of loopholes, you enrage lots of people, and that's politically very dangerous. So the idea that we might actually lower tax brackets and then close a lot of loopholes in order to pay for the lowering of tax rates is kind of far-fetched. It's really just very hard to do. So maybe they'll try, maybe they'll do a little bit, but they won't do much. And in any event, when you're this indebted, there's no magic tax rate that can fix all that debt. There's no interest rate that saves us. There's no tax rate that saves us. There's no health care plan that fixes the economy. There's no immigration law that turns us from the world's biggest debtor into a creditor, a healthy, sustainable economy. None of that helps when you've borrowed this much money. There's only some kind of a crisis to get yourself out of this debt, and that is incredibly painful. So we'll thrash around here in the U.S. proposing all kinds of things. We will do new immigration laws, and we'll fiddle around with the health care law that we've got now, and of course we'll fiddle around with taxes, but none of it will mean a thing, because we continue to borrow huge amounts of money. And somehow, some way, that debt has to be managed. In other words, we got to pay the interest on it, and then it has to be paid off. We got to get the principal back somehow. And we can't do it. We don't have the wealth in this system to manage the amount of debt that we've taken on. And there's no tax reform that will give us the wealth-creating capability to cover our debts. So we have this big crisis out there somewhere, Jim, that is inevitable. Now, whether it's imminent or not, that's the question, because it seems like it's been ready to blow up for years and years now. And it hasn't. We've been able to manage the ever-increasing mountain of debt by cutting interest rates and by creating new currency and by fiddling around with other things here and there. And it's worked for a while. It won't work forever. Someday there's a crisis out there, but it may not be this year, may not be next year, although it might be too. You know, we could wake up some morning and find that something happened in the Asian markets that have flat out closed down the North American markets, and then that's it. You know, then we're there. You know, the currency crisis / debt implosion is with us, and we will wish we had prepared before that day. You know, that's the real question now is, how do you prepare for something that you see coming, but the timing of which is impossible to predict? And a lot of people who, for instance, sold their stocks and maybe went short the stock market in the U.S. are really suffering right now. Or people who loaded up on precious metals in anticipation of a crisis that hasn't yet come are sitting on the sidelines and watching equity prices go up and up and up, you know, or wishing they'd bought Bitcoin or something like that. So the preparation part of this is very intellectually challenging, and there are no right answers given what we know now. You know, in retrospect, there's going to be right answer. There's going to be a thing that a few people did that everybody else wishes they'd done. And that's the challenge, you know, is finding that mix of prepping policies that put you in exactly the best position for exactly the crisis that comes. And you know, doing that is more a matter of luck than anything else. So what people should be trying to do is to get as close as possible to that perfect mix of prepping policy, without any expectation of just nailing it, you know, because that would be insanely lucky to do something like that.
Well, sure, it's like having a list of 18 football games and getting them all right. Sure, you can win $1 million if you do, but what are the odds?
Yeah, exactly. Because the future is inherently unknowable. You know, the crises that we're going to see over the coming decade depend in part on the mistakes that we've made in the past, which are highly visible, you know, and have historical precedents and give us some clues because of that. But also, in part, these crises are going to be due to the decisions that people make under pressure going forward. And that's not predictable. You know, what's the Bank of Japan going to do when the Japanese yen starts to collapse because they've taken on so much debt? You know, they might raise interest rates to protect the yen, or they might just let it go and cut interest rates to protect the real economy, or they might do some other thing that's completely unrelated to those things. Just can't know that. Same thing with the U.S. Fed, same thing with, you know, the Bank of Canada, same thing with the Bank of England and the European Central Bank. We don't know what those guys are going to do. And we also don't know how the geopolitical thing is going to play out. You know, are we going to bomb North Korea? We might. It certainly sounds like the U.S. administration is considering war on the Korean Peninsula again. And if that happens, kind of all bets are off financially, right? I mean, if we start dropping bombs on a nuclear power that is only 35 miles north of the capital city of South Korea that has 25 million people in it, you know, that's a scenario that's really hard to imagine, which means it's really hard to plan for. Because what does that do to the financial markets? Bad things, for sure, but we're not, you know, completely sure what kind of bad things, because we don't know exactly the form that a war in that part of the world will take. So, I don't know. You know, I think the safest thing to do is just be willing to forego the easy money in these bubble markets and scale back, you know, own precious metals, even if they're not going up as fast as stocks right now, because, you know, eventually they will do better than equities for a couple of really big, really crazy years, and you'll be glad you had precious metals, you know. Fiat currency cash is a good thing to have because that's the most liquid thing in the event, for instance, of a cyber attack that knocks out the banking system for a while. And you can't get into your ATM machine. Well, if you've got some cash, then you can get by for a while. And you know, beyond that, it's not really clear what is both safe and prudent to do. You know, if you're aggressive and you want to start shorting the stock market, historically, these valuation levels scream, short me. You know, if you'd shorted every previous market that was more or less valued this way, you'd have made a ton of money every single time. This time is somewhat different because all the central banks of the world have unlimited printing presses, and they don't seem to be too shy about using them to buy things like equities, So it might not go exactly the way it has in the past, but then again, it might. If valuation still means anything, aggressive investors and speculators have a chance to make a lot of money by shorting the market. But I wouldn't recommend that for most people because it's dangerous. You can short something and it can go up to infinity from where you shorted it. So your potential loss is theoretically unlimited, and that's very, very dangerous. Most people aren't comfortable with that kind of a risk profile, nor should they be. But somebody's going to make a ton of money shorting this market at some point in the not too distant future, I think.
We'll have more with John Rubino right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with John Rubino. John, China has worked out a deal with Saudi Arabia to buy oil for yuan, bypassing the U.S. dollar. Do you see other countries trying to do that? Or is there a warning from both Iraq and Libya that tried to work out deals to sell gold or oil for more than just U.S. dollars?
Well, yeah, historically, countries who mess with the petrodollar monopoly tend to see regime change. and anybody else who wants to do that going forward has got to be aware of the U.S.'s willingness to intervene to protect the dollar's monopoly in the world oil markets and the dollar's preeminence as a reserve currency. But a lot of people in a lot of countries would love to see the U.S. dollar fail because we've kind of abused our power. Let's be honest here. Painfully honest. We were basically handed an unlimited credit card by the Bretton Woods monetary agreement and by what came after, in which the whole world needs dollars as the main reserve currency, and that allows us to basically create as many as we want to, toss them out in the world in return for free stuff or for real stuff. And in that way, build a military empire that nobody else in the world can touch, and a cradle-to-grave entitlement system that costs $1 trillion or so a year. Either one of those things would be extremely difficult to manage for any other country, but we're doing both because we've got the world's reserve currency. A lot of other countries are kind of chafing under, in effect, U.S. rule, China would like to be a power in its region. Russia would like to be a regional power, if not a global power. And Saudi Arabia is kind of caught in the middle of all this because they basically would like to sell their oil and not be invaded. That's what they want. And while the U.S. was the absolute unquestioned superpower of the world, then living under the U.S. military and political umbrella was comfortable for the Saudis. But the fact that they are hedging their bets a bit means they don't see us as the only thing that matters in the world anymore. And that should be a scary thing for U.S. policymakers because there's this gigantic overhang of dollars out in the world. There's like $15 trillion U.S. dollars outside of our borders. And right now, everybody wants those dollars. But if a lot of, for instance, other central banks decide they only want dollars equal to half their foreign exchange reserves, and today they've got 65%. Well, they're going to dump 15% of their, or 15 percentage points of their dollars on the open market somehow. Let 2 or 3 central banks and a lot of international trading companies do that, and those dollars are headed back home. and that's going to be destabilizing for us. It could be very inflationary because those dollars will come back here wanting to buy U.S. stuff. That'll push the price of things up at a time when we really don't understand inflation in our system as it is. Right now you see the Fed talking heads coming out and saying, well, we just aren't sure why inflation hasn't picked up given what we've done so far, and that level of cluelessness when it's confronted with something as dramatic as a tsunami of dollars coming back home and really destabilizing prices, that's a bad combination. But that's what we could see pretty soon. So, yeah.
Isn't the lack of inflation actually good news for the average American? Because nobody has seen an effective wage increase in the last 20 years. So if prices come down, doesn't that give you more buying power with your weak dollar?
Yeah. The guys in charge of these deeply indebted systems now need inflation in order to lower the burden of their debts. Because if the currency is becoming less and less valuable year after year, that means you can pay your debts off with cheaper currency. It's easier to get cheaper currency. And it increases the odds that you won't go bankrupt from all the debt that you've taken on. So the consensus within the mainstream economics community is that 2% or 3% or 4%, choose your favorite number, of inflation is good because it makes debts easier to manage and it allows people to get nominal raises, even if not real raises, and basically just greases the gears of capitalism. And that is just fundamentally wrong on every level. As you said, deflation is the sign of a healthy economy because that means we're getting more productive about making things. So we can make them more cheaply, but the currency is holding its value, which is basically another way of saying the government is keeping its promise to the people who hold its currency that the currency will continue to hold value and going forward. So combine a government that's keeping its promises with a private sector that gets more productive every year, and prices ought to fall a little bit year after year. And if you look back at the century of the classical gold standard, which is basically the early 1800s to 1914 when World War I started, we had, on average, a little bit of deflation year after year because all the major currencies of the world were basically just names for certain weights of gold. And gold only goes up in supply by about 1.5% a year because it's hard to get. You got to dig it out of the ground. You can't get that much in any given year. So that limited supply led to stable prices. Gold held its value, and the currencies that were just names for weights of gold held their value by implication. And meanwhile, businesses got more and more productive year after year, so prices went down a little bit. And we had good, solid growth, and we lifted millions of people out of lower class to middle class. And the system worked very, very well. We were progressing really dramatically. We were talking about a golden age in which all our problems were going to be solved going into World War I. And then all bets were off, because the system just totally spun out of control. And since that time, we've had monetary chaos. But the fact that we went a century with our currencies linked to gold and had a very, very healthy global economy that generated deflation year after year kind of implies that this whole, we need 2 or 3 or 4% inflation every year in order for the economy to work right, it implies that doesn't make any sense. That's just the rationalization of people who have presided over a debt binge that leaves them no choice but to devalue their currencies. So they're pretending that it's actually a positive idea and a good thing to devalue your currency year after year rather than the act of a desperate, incompetent, soon to be swept into the dustbin of history system,
We'll have more with John Rubino right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with John Rubino. John, the Bank of Canada says it's getting indications that there's going to be a labor shortage. In the Vancouver area, restaurants are either closing or reducing their hours because they can't find cooks. And I'm wondering, is it a case of Vancouver is so expensive to live in, people who get paid so little to be a cook these days, they can't afford to live here?
Well, that's the nature of real estate bubbles, wherever you are. You know, when real estate starts going through the roof, if you're a cop or a teacher or a firefighter or, you know, a restaurant employee, you can't get paid enough to live in these places where rents that, you know, a little apartment that used to be $700 a month is now $2,000 a month. And you're still making enough to pay for that $700 a month apartment, but nowhere near enough for the $2,000. And see, that really lowers the livability of a city when the people who directly impact, who manage the livability of the city, you know, the school teachers and the librarians and the firefighters, when these guys can't live there anymore, then the quality of life in that place plummets. And we're seeing that everywhere in the world now. Vancouver is a particularly interesting case because it's got really three forces pushing up prices there. One is just the general, you know, loose monetary conditions in the world, which is affecting all major cities. Two is that Vancouver is this awesome city that everybody's discovering, you know, and anybody who is thinking of moving has Vancouver on their list because it's a great place. It's my favorite place in the Northwest to visit by far. And the third is that all that Chinese money keeps wanting to pour into this part of North America. You know, Chinese people love Vancouver real estate, and they're generating millionaires like crazy over there who don't trust their system. So as soon as you get rich in China, you figure out a way to get some of that money out to a safer place. And some of it flows into Seattle. A ton of it flew into Vancouver. I understand less so now, but still. That's part of the bubble of the last 20 years in Vancouver. So you put those three things together and it becomes an incredibly expensive place to live with no real end in sight until the credit bubble bursts, and then you'll see prices plummet. You know, I'll go out on a limb and say Vancouver real estate will be half as expensive 5 years from now as it is today. But that doesn't mean it won't double one more time first before it collapses. So we can't really make up a trading strategy based on that assertion of mine. But you can kind of map your future based on it. You know, if you aren't moving now, but you're thinking, you know, when I finish this thing that's going to take me 3 or 4 years here in this place, and maybe I'll move then. Vancouver is definitely some place to look at because it might be much cheaper in the next crisis.
Well, one of the things too with Vancouver, between 23 to 40,000 people a year move here.
Yeah,
and it doesn't matter what the local Vancouver economy is doing. Other people come here just because, you know, compared to the rest of Canada, we don't have winter. It's wet, but you don't have to shovel rain.
Well, that's part of Vancouver's charm is that it has good weather compared to where it is. You know, you wouldn't look at a map and say, "Oh, that place has nice weather," right? Because it's way up north, but it does because of airflows and everything. It's actually nicer weather than Seattle, I'm told.
Yes.
Even though Seattle is few hours, an hour and something south. I don't know exactly how.
Depends how long the border lineup is. Yeah. it's an hour and a half to 2.5 hours away.
Yeah. It's just a great town. So there will always be in-migration to Seattle. To Vancouver. But there doesn't have to be a bubble, you know. You can have steady in-migration, and that keeps a floor under prices without causing them to double, triple, quadruple like has happened in the past decade or two.
Well, I moved into Vancouver in the early 80s. There were 1 million people here. Now it's close to 3 million. So really, if you just ballpark it, it's almost 50,000 people a year, no matter what.
And you know what the sad thing is about that is that eventually a place loses the charm that attracted the original in-migration to it. When
The homeless problem here is astronomical, and it only used to be downtown Vancouver. It's now in the suburbs. You can't go anywhere without finding homeless people sleeping in a doorway.
Yeah. Well, that happened to California completely. You know, the entire state of California over the past 30 or 40 years. Beautiful weather, you know, cheap housing and stuff. And we all moved there, you know, or millions and millions of Americans moved there. And now it's a nightmare landscape. You know, the traffic is insane. I would never, ever live in Los Angeles after having visited a few times because it's just too crowded. So Vancouver's in danger of going that same way unless they find a way to manage inflows. But people who run cities don't like that because usually that's the real estate developers and the politicians, and they love having more people there because more people means more demand for housing if you're a developer, or stores. You know, if you're building big box stores, you want people to move there and shop in your stores. And if you're a politician, you want the power that comes with having 5 million people instead of 2 million people that you're responsible for. So there isn't the institutional sense on the part of a lot of places to kind of control their growth the way you'd think there would be if they cared about
put a
the
sign up
quality
saying,
of life.
sorry, a sign up at the edge of the city, sorry, we're full.
Well, yeah, or that would be a logical thing to put up for a lot of places. Exactly that. You know, look, we love having you come visit, come stay for 2 weeks, fill up our hotels, but then go home, please. There's enough of us here already. And you can do that with zoning laws, where you just make it extremely expensive to build more, for instance, residential housing, and you don't build more roads, and you control the retail sprawl, you know, and it's doable. For instance, Portland, Oregon has some interesting laws, and I'm not really up to speed on the details of them, but as I understand it, they basically drew a circle around the city and said no development beyond this circle. We're going to have green space and you know, open areas, and it's going to be nice to be there. We're not going to just pave it over and build subdivisions and strip malls. Now that means they pass up an awful lot of tax revenue, which means there's always going to be this tension where a new slate of city council members are going to be elected to put forth, you know, an agenda of smart growth, which won't be smart, probably. And so the current plan in Portland might not last, but I think it's something to look at for cities as a potential solution to the fact that your quality of life is going to be ruined if you allow unlimited in-migration. So, I don't know.
Well, Vancouver has,
in a few places.
Right, British Columbia has the agricultural land reserve, where they're not supposed to pave over all this rich delta farmland, except they keep finding exceptions. Well, in this case, we'll let you put a mall up there. Or, for some reason, it's okay to put greenhouses on top of farmland. Well, you can put a greenhouse anywhere. But now they're letting these greenhouses on top of this rich loam soil from all the floods that the Fraser River used to do annually, and they've diked up. So it's still not really farmland. It's being used for an industrial purpose.
Yeah.
So even doing that, they always find ways around it.
Yeah. And, you know, there's always going to be serious bribe money at stake, right? Because if you can put up a mall.
We don't call them bribes, they're election contributions.
Yeah. Contributions to election campaigns, yeah.
Right.
Legal bribery.
And also, you see all the ex-politicians on the boards of all these big companies, you know, getting paid, I don't know, $200,000, $300,000 a year to meet twice a year.
For a lot of politicians and regulators, those jobs are just extended job interviews in which they show the industries that they eventually want to join that they can be good team players. Then, when they get voted out of office or they've been a regulator long enough, they go work at one of these companies at 5 or 10 times what they were making when they worked for the government. And they know they're going to do this while they're working in the government. So they're not going to cross the companies that they're regulating, right? Because that's their future employer. And, here in the U.S., it's insanely bad. I mean, with the banks, my God, government regulators will oversee the banks for a few years and then go join one of the banks or a hedge fund or something like that at astronomical increases in their salary. So, of course, the banks get to run the government because everybody wants to go work for them who's now in the government. No, terrible. It's a recipe for the kind of disaster that we have coming, in that kind of a world where bankers or other corporate interests basically run the government and get to dictate policy. You end up with vastly too much debt and then some kind of a crisis out there in the future. But, of course, the guys who are engineering it get to retire rich and go off into the sunset, or get to retire and then take the money they've accumulated and buy gold and silver with it, and then get rich again when the crisis they engineered finally hits. Yeah, it's very frustrating, Jim. This is a badly run world, and you have to hope that out of the rubble of it, we build something that's a little bit more honest in the future, but that might be kind of a pipe dream. I don't know.
Well, there's two major jobs in this world that you don't need a certificate, a degree, or college training, and that's being a parent or being a politician. And they're probably the two most important jobs on the planet.
Yeah.
John, thank you so much for chatting with us.
Sure thing, Jim. Good talking to you.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. If you have any questions for us or our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.